In August 1998, a group of the world's most respected accumulated as a one-in-several-hundred-million-day event. Yet, on August 21st, 1998, they lost $550 million in a single day. This was not simply a bad trade or a moment of height of LTCM's success. The presence of these laureates gave the fund an aura of mathematical invincibility. When LTCM spoke, the markets listened. To make these nickels meaningful, LTCM utilized massive leverage. This is where the structural vulnerability was introduced. By 1998, the fund had a capital base of $4.8 billion. This was a significant sum, but it was nothing compared to the positions they controlled. The fund used its capital as collateral to borrow staggering amounts of money. They used that leverage to control over $120 billion in assets. But even that number is a conservative estimate of their influence. Their total off-balance sheet positions, the architecture of their derivative bets, exceeded $1.2 trillion. For every $1 of their own money, they were betting $25 of borrowed money. In some specific positions, that ratio was even higher. They were not just participants in the market, they were the market. They were so large that they could not move without shifting the entire global price structure. The banks were more than happy to lend to them. LTCM was seen as the safest bet in the world. Their models were back-tested against decades of historical data. They had survived the bond market crash of 1994 and the Asian financial crisis of 1997. To the institutional lenders, LTCM was not a risk. It was the gold standard of risk management. In August 1998, the map and the territory finally diverged. The model was built on a foundational assumption that markets are rational and that history is a reliable blueprint for the future. But history is full of black swan events, occurrences that fall outside the bell curve of probability. The catalyst was Russia. On August 17th, the Russian government defaulted on its debt and devalued the ruble. This was an unprecedented move for a nuclear-armed power. It sent a shockwave through the global financial architecture. In times of extreme crisis, market participants do not act rationally. They do not wait for prices to converge. They engage in what economists call a flight to quality. Investors around the world liquidated their holdings in emerging markets and poured their capital into the safest asset on Earth, the U.S. Treasury bond. This flight to quality had a catastrophic effect on LTCM's positions. The model predicted that as markets panicked, the tiny price gaps they were betting on would close. Instead, those gaps widened. The mathematical correlations that the Nobel laureates relied on, the very laws of their universe, simply vanished. When the world's investors all tried to get through the same exit door at the same time, the door was too small. The liquidity that LTCM's model assumed would always be there was gone. The pennies they were vacuuming up turned into thousands of pounds of debt. On August 21st, 1998, the internal dashboard at LTCM's headquarters in Greenwich, Connecticut, showed a one-day loss of $550 million. The 15 standard deviation event was no longer a theoretical abstraction. It was a forensic reality. By the end of the month, the fund had lost nearly half of its total equity. Their capital was being incinerated at a rate that no one in the room had ever thought possible. The danger was not just to the partners of LTCM. Because of their massive leverage, their counterparties were the biggest banks in the world: Chase Manhattan, Goldman Sachs, Merrill Lynch, and J.P. Morgan. If LTCM collapsed, they would be forced to liquidate their $1.2 trillion portfolio at fire sale prices. This liquidation would have triggered a chain reaction. It would have wiped out the capital of the banks themselves, freezing the global credit market. Businesses would not have been able to get loans. Mortgages would have stopped. The very plumbing of the global economy was on the verge of a total systemic seizure. On September 20th, 1998, senior regulators from the New York Supervisory Authority realized that the situation had moved beyond the control of the private sector. They called a meeting at the regulatory offices. The participants were the CEOs of the 14 largest banks in the world. They were competitors, but they were brought together by a shared existential threat. The meeting was private, which is the standard procedural practice for systemic risk negotiations. There were no cameras, and there was no press. The regulators did not use taxpayer money to bail out the fund. Instead, they acted as the mediator. They presented the banks with a choice: either manage a controlled liquidation together or watch the entire financial system unravel. After hours of negotiation, 13 of the 14 banks agreed to provide a $3.65 billion private life support package. Each bank contributed between $100 and $300 million. In exchange, they received 90% of the equity in LTCM. Won't be in the news until it's too late.